Hey, how you doing? Welcome to Wall Street Weatherman. I am Gregory Joseph, and what am I talking about? The title of this show is a warning about exchange traded funds, ETFs. I thought ETFs were kind of like this great wrapper where you got all the wonderful performance and none of the risk. So, I'm going to tell you why that just isn't the case. But don't take my word for it. I want to start off with a quote from one of the greats. That's Charlie Munger. Charlie Munger, the longtime business partner of Warren Buffett. They ran Berkshire Hathaway for decades. And oh my gosh, Charlie Munger, if you haven't seen, listened to, some of his clips, and rest in peace, Charlie, because we miss you. But please do yourself a favor, go back. This man was so smart, so intelligent in business, in law, in finance, but he could take the most complex concepts and pare them down to amazing, short, witty sayings. And one of those sayings was diversification is the enemy of performance. Okay? Diversification is the enemy of performance. The reason that that's the case is because I know that for, let's say in my father's era, they were told that you needed a diversified portfolio. And these days, you'll hear it being called a barbell approach, to where, you've got a sort of ballast, a balance that if something happens over here, this side is going to balance it out. And that's true. That is completely true. And you can get that balance, and if you want. But if you just think about it basically, if you have the balance, then you're decreasing your risk by, having some high growth over here and some more staples, things that do well in a down economy over here. But you're not going to, what you give up, the cost for that lower risk is the upside performance. You're not by, common sense. If you're protected on the downside with that balance, you are putting in a ceiling at the upper end when it comes to performance as well. Because when something shoots up over here, the exact opposite is going to be true. So diversification is the enemy of performance. I firmly believe that. But I'm going to tell you what you can do about that. And if you're a long-term investor, I'm not saying that ETFs are not great. Again, you go back in my videos and you look at, there are 1,000 ways to invest and make money. Long-term, short-term, bull, bear, the whole thing. And if you're a long-term investor, ETFs can be amazing for part of your portfolio. And this is the one way that, and I hold an ETF in my portfolio, which is called the SPY. Okay. The SPY just happens to be one of several different ETFs that you can get by different companies. This is the Spider ETF, and it is automatically geared to mimic the S&P 500. Okay. The S&P 500 over time, decades and decades over its history, has returned an average of 10.5%. If that is good for you and you want to protect your money, you can get that protection of the S&P, of all the 500 stocks, of, over 90% of the entire market, and just bet on the overall market going up, coming down, but going up over time. So if you buy the SPY, that's the ticker symbol, SPY. If you buy that exchange traded fund and you hold it, then you are betting long term that the market is going to go and up, along its average of 10.5%. That is the one case, being holding it longer term, that I would advocate for that. Other than that, Um, I would still argue that if you if you like a sector, if you like what technology is doing, or you really like healthcare because you believe that the boomer generation is aging and they're going to need more and more healthcare, whatever it might be, fantastic. I always advocate for starting at one of the 11 sectors and working your way down. Every day I sit down, I think about what is the overall market doing? Okay. Is the water rising in is the tide rising in the marina or is it falling? Because even the best stock in a falling tide, is tricky. So I start with the overall market. I work my way down to sectors. From there, I go to individual stocks. Always work with the largest catalyst first when we talk about trading. So, um, that being said, that if you love a sector, if you look at the market and think that it's doing well, and you see it, behaving, having strong price action, and it's a good time to start to buy into a stock, which we do in pieces. Go back in previous videos and check that out to protect yourself. We never buy all at once, but if that's what you believe, that the market's doing well and price action is good and it's going up, and you've been looking at, let's just say, healthcare for a while, fantastic. Okay. You don't need to buy the overall healthcare ETF. You can look at parts of the healthcare sector. You can look at managed healthcare. You can look at um, long-term care for people. I'm thinking of there's a stock called Welltower, for example, that specializes in real estate investment trusts that have long-term care facilities that they own, and some of them they lease out. But for example, anyhow, in healthcare, you can still whittle down to what part of it you like. You like the pharmacology. You like you like biotech, again, managed healthcare. And from there, as we've talked about before, find your sector, find the area within that sector that excites you the most, and find the best in class always. I can't tell you the best way that I can think about in terms of diversification is to always find the best in class. Okay. And that right there is going to help you in so many ways. So even in the long term, if you do that, rather than taking $100 and putting it into the overall healthcare sector, if you whittle it down to the sector and then the subsector and finding the best in class in that sector using all the tools that we've talked about before, looking at all of the metrics and financial performance, and very simple. Remember that there were the 7 different things that we talked about: cash flow and profit margins. You find the best in class, leg into that stock instead. I found this to be a very successful strategy. Again, it goes back to the investor psychology, the behavioral finance that we've talked about, where I really truly think that exchange traded funds are sold, making people think that they are protecting themselves with a balance of, oh, I'll have 10 or 20 names in healthcare and that'll give me balance. True, absolutely true. But you also will limit yourself by the very balance that we're talking about, the give and take on the upside. So with that in mind, and maybe as proof of that too, um, I wrote down that saying that I think many of us know, that you can you can please some of the people all of the time, you can please all of the people some of the time, but you can't please all of the people all of the time. It just doesn't work like that. So being realistic about it. However, that being said, the ETF business is unbelievable. It's crazy. When I mean, I've got subscriptions to, as you know, different CNBC, Financial Times, Bloomberg, things like that. But when I will see them on the TV, um, the number of ads for ETFs is incredible. And I want to tell you this right now, which just this year, the number of ETFs has surpassed the overall number of stocks available to trade, which is crazy. So think about that. We've got about, at this point, a little more than 3,000 stocks on the New York Stock Exchange that can be traded. There are 4,000 ETFs, and all the ETFs do are take those 3,000 and pick and choose individual ones, wrap them up and put them into an ETF. And importantly, they charge an expense ratio. They charge you for investing in that. So if you think about that, they're taking those 3,000 approximately stocks and repackaging them into more than 3,000 packages. So therefore, automatically, each stock must be in more than one of those packages, which is 100% true. Here's the statistics. The average S&P 500, the 500 of, the largest, the best stocks, the most representational stocks in the market, the average single stock in the S&P 500, guess how many baskets it's in? Guess how many of those bags, its wrappers it's in? 600. 600, that's on average. So you just take your average, stock in the S&P 500, number 200, number 306, it is on average in 600 different ETFs, that same stock. The highest capitalized stocks, the biggest companies like Nvidia, for example, how many ETFs hold the Nvidia stock? I was blown away. Okay, it's 1,600. 1,600 different ETFs hold the exact same stock, which is Nvidia, which is crazy. And that being said, you can see that ETFs sell very well. People buy them. And but I want you to think about the promise and that investor mindset that, oh, I can minimize my risk, but still get the upside. Doesn't work like that. That's not the balance. So with so many of these ETFs, if you think about it as well, you buy one ETF, you buy two, you buy three ETFs. Those three ETFs are going to hold some of the exact same stocks in there. More than likely. I mean, go and look at it. You can just go and we talk about Yahoo Finance. You can go straight down on the ETF and press on holdings and you'll see what's in there and you can expand that, or go to Google or, Gemini, Perplexity, ChatGPT, and just say, tell me the stocks that are in this ETF, this exchange traded fund. And you will be, well, maybe not surprised after we've talked about this, but if you buy those three ETFs and those ETFs hold many of the same stocks, aren't you just buying that many of those stocks again and paying an expense ratio on top of that? Yes, yes, yes is the answer. So my thought is, sure, maybe for one as a ballast, I have the SPY, which is the S&P 500. Again, you can find other exchange traded funds that mimic that track the overall pace that the S&P 500. Maybe that for a ballast, an overall ballast of betting on the market long term. But other than that, if you buy those three ETFs or four or five different ETFs, you are buying so many stocks again and paying again for those stocks that maybe just do research and invest in the best of the best and do it wisely, like we've talked about before. Save yourself the expense ratios that add up and go at it like that. So And by the way, when we're talking about risk, think about that too. If you're like, oh, well, I really like this and I'm going to allocate this much money to this ETF and another one to this ETF, if let's say those three exchange traded funds all have the same stock in there, then you just tripled your exposure to a single stock. Maybe that wasn't your intent, in the beginning to allocate that much of your money to, a single stock that exists in all three. Well, right there, you've already upped your risk unintentionally. So, that's something to consider as well. And just a couple more things, and we are done. So leveraged ETFs, I just want to tell you that I am, surprise, surprise. If I'm not the biggest fan of ETFs, because I think with a little homework, you can outperform them by finding the best of the best and going for that one. The leveraged ETFs, I am a big non-fan of, if that's a word or phrase. But the leveraged ETFs are just that they are, for example, let's say that you find, let's say NVIDIA, for example, you can buy an NVIDIA double levered ETF. So it is for every $1 move in the stock, it moves twice that or three times that. It can be a triple levered ETF. You find these in crazy speculative names already. All I'm going to say is this. You and I talked about how to invest wisely and to increase your profit buffer as protection to the downside for sudden, reversals in stocks. But by doing that, by taking that stock and doing a double or triple levered ETF on it, number one, you're paying that expense ratio, which I'm going to keep talking about. You're paying someone to do something that you can probably do better if you use, a few of the tools that we discussed. But whatever the beta is on that stock, and going back, we talked about beta equals risk. A beta measurement of 1 means that if the S&P goes up 1%, your stock goes up 1%. Drops 1%, it drops 1%. A beta of 2, it moves twice as much. So 1% in the S&P means 2% in a 2 beta stock. If you take a stock with a beta of 2, and we talked about, really making an effort to in terms of risk management, to buy something with beta of 2 or less. Closer to 1 is much better. 1 to 1.5, we love that. But if on your overall investment thesis, you've got a little bit more risk out here, which is cool, absolutely. But you've got a stock with a beta of 2, and you buy a triple levered ETF, you are taking that beta, that risk, from double the market to 6 times the market. Okay. And that is just not prudent. Okay. If you want that much risk, you can always take the stock and allocate more money to it at its original risk beta. But when you get into levered ETFs, your risk goes up by a multiple, and not a fan, as you picked up on that. So that being said, that's pretty much it. And again, I just want to uh, remind both of us, all of us, about that wonderful saying by Charlie Munger that diversification is the enemy of performance. Okay? You can do better. You can do a little bit of homework. You can find the best in class. Find the sector you love. Find that part that you really believe in. Do your homework. Take the top 3 and do an analysis with the few measurements that we talked about. Find that best in class and invest in parts slowly into it. Do it smartly, and you will do great. It's a wonderful strategy, but don't take my word for it. Take one of the greatest investors of all time, Charlie Munger. Take his word for it. So I hope that helps, guys. It's been great being here today. Thank you for watching as always, and I will see you again soon. Take care.